All right. Well, look, I think we might get underway. My name's Jeff McClelland. I am the New South Wales State Chair and the ASA board member. Today we have another great webinar this week from Fidelity, and Maroon Yunus. Is that how you say it?
That's correct.
Yep.
Yunus.
And he's a co-portfolio manager in the Fidelity Global Future Leaders Fund. But today he's focused on global small and mid caps. Now, Maroon's been with Fidelity for I think 13 years or something, and prior to that was says me looking at the thing was with someone else. Remind me, Maroon. Sorry.
Willis Towers Watson.
Willis Towers Watson. I should have known. So so very good background. Long-term Fidelity, and a CFA charter holder. So this should be a very good chat. And Maroon will talk for sort of 20 to 30 minutes, and then we'll take some questions afterwards. So over to you, Maroon.
Great. Thanks for that, Jeff, and thanks for everyone to dial in today. Yes, as Jeff said, we'll be going through the global mid-cap opportunity set, which is the focus of what I do day in, day out. And so maybe just a quick background on Fidelity for those who don't know. We're a large multinational. We've got a footprint in most major markets around the world. A little bit under $1 trillion US dollars in assets under management. Lots of clients around the world. We've been in business for over 50 years, and over 400 investment professionals all around the world. So thankfully, we are a very well-resourced organization, and I use that to my advantage to draw upon the full resources of the Fidelity network. I thought maybe we'll just take a step back and just talk about global mid-caps for a second, because when we talk about mid-caps in Australia and when we talk about mid-caps globally, they mean vastly different things. So here you can see a handful of Australian names, household names, most of these. These all classify as global mid-caps, believe it or not. These are some of the largest names in Australia, some of the more mature names in this country, more established businesses. And by the global definition, these are global mid-caps as well. So this is looking at it in terms of age. You can see there that light blue line, which is the world mid-cap, and then the dark blue line, which is the ASX 50. So the top 50 companies in Australia, on average, have been around for 25 years, which is pretty much the same as the global mid-cap. So both from a size as well as in terms of how long these businesses have been around, global mid-caps are actually comparable to some of the largest names in this country. So I don't want viewers to think global mid-caps are tiny businesses that are not profitable, that have just been IPO'd or listed in the last 5 or 10 years. By and large, what we invest in are businesses that have been around for generations, well-established, vastly profitable, and well-resourced organizations. Why we like global mid-caps, this chart goes through it, very quickly. It is relatively under-researched versus large caps. The number of investors, the number of sell-side brokers, the number of independent third parties that looking at the companies in this universe are a lot less than the number of people looking at companies like Apple and Microsoft and Amazon. And because they're not as well researched, that increases the opportunity for mispricing, and therefore the opportunity to add value via in-depth research. On the other hand, they're also a lot less risky than if you went into the smaller microcap end of the market. So it sort of sits in that Goldilocks where you can get more alpha, more return than large caps over time. But at the same time, you don't have to dial up your risk metrics too much, as opposed to if you went down to the smaller microcap end of town. And so you sort of sit in this nice little sweet spot, which is beautiful. Not a lot of large cap managers are getting exposure to this. So if you looked at some of the more popular broad cap managers or products or indices, most of them are still generating the vast majority of their returns from the larger mega cap names. And finally, you put it all together, in terms of risk-adjusted returns, it's actually very attractive, and I'll go through that in a couple of slides. Here we're looking at the global mid-cap universe versus the large cap universe, and mid-caps are on the right in the orange and large caps are on the left in the blue. The top charts you can see there, it's the sector or industry breakdown. Unsurprisingly, in that top left chart, you can see IT is almost a quarter of the fund, which is your global large caps. By contrast, the bar chart on the right, you don't have anywhere near as great level of concentration in IT, and a lot more even dispersion across sectors. Similarly, if you sort of go down into the into the tables below, you can see this at a stock level. Again, almost a quarter of your exposure is in that top 10, which most of them are IT names as well. And you look at the mid-cap universe, the top 10 names make up less than 5%. So not only do you get more diversification versus large caps across sectors, you also get more diversification and less concentration at a stock level as well, which is really important. And then I mentioned a couple of slides ago in terms of good risk-adjusted returns. This slide basically sort of puts it all into perspective. So obviously the last 5 to maybe 10 years, large caps and mega caps have dominated all the news flow, but historically that has not been the case. Certainly what we've seen over the last 5 or so years is more an anomaly rather than the rule. And you can see this in the chart on the left-hand side, the orange line, which is the world mid-cap index, has outperformed comfortably the world large cap index over time. And it's going back 25 years. So quite a long, rich history of data there. It does outperform over time. Sure, it does come with a little bit more by way of risk as measured by standard deviation. You can see that in the top right chart where that orange dot is a little bit further to the right than the blue dot. But when you put it into a Sharpe ratio, which is looking at risk-adjusted returns, it's much more compelling in terms of the mid-cap universe versus large cap. So this, I think, is why we like this segment of the universe from a long-term perspective. We think it adds a lot more to your returns, and it doesn't dial up the risk profile all that much. And so from a risk-adjusted return basis, it's actually very beneficial to have an exposure to this asset class over the long term. But what makes it even more compelling right here, right now, as we talk, is the valuation opportunity. So this is looking at price to earnings in the blue and the price to book in the orange. And you can see there the ratio. So this is the ratio of price to earnings for large caps. Sorry, the price earnings ratio of small caps divided by the price earnings ratio of large caps. So when that ratio is 1, it means they're trading at the same multiple. When it's less than 1, it means that the small and mid caps are trading at a cheaper multiple than large caps. And you can see with the blue line there, for the majority of its history going back to 2003, small and mid caps have traded at a level above 1, so at a premium to large caps. That's really changed course probably from about 2021, 22 onwards, and we can see now it's trading at discount levels that we haven't seen in over 20 years. Similarly, from a price to book perspective, where we are right now in terms of that ratio, that valuation discount is at levels we haven't seen for a very long time. So not only do we like this asset or this segment of the universe structurally from a long-term perspective because of these good risk-adjusted returns that I spoke about previously, but also right now, the opportunity to get into this segment of the market from a valuation perspective has never looked as compelling as what it does now in almost 30 years. Looking at this segment of the universe, it's surprising, but a lot of the market leaders today, once upon a time were small and mid caps. It's hard to believe, but once upon a time, Apple, Amazon, Microsoft, they were all tiny, small and mid caps, and they've gone on to become future leaders. So what we're trying to do effectively in the Fidelity Global Future Leaders Fund is identify some of these leaders of tomorrow or the winners of tomorrow. This list is not exhaustive by any means, but you could see there's 5 sectors where we tend to find quite rich opportunity set. Technology, in energy, and particularly in some of the more innovative energy areas, consumer, financials, healthcare. And you can see there it sort of spans across many different areas within technology. I mean, right now it's all about artificial intelligence, but there's so much going on in terms of software, connectivity, all those sorts of things. And what we've done in the column on the right is just give you a little sneak peek in terms of one name per area that we have in the fund right now. So if I just take GTT, for example, which is in energy, most people will sort of think of energy, drilling for oil. Like a company like GTT, what they do is they have the technology. So when you make a LNG tanker, you got to take the gas, you got to turn it into a liquid to be able to put it in these tanks and then be able to transport it, across the oceans. In order to keep it structurally intact within the tanker, the large tanks that it's put in, it has to be encased with a particular membrane that holds the liquid in form. GTT is basically the global monopoly on that technology, and they license out that technology to every shipbuilder. So every Korean, Chinese, Japanese shipbuilder that is building an LNG tanker will license that piece of technology from GTT, pay them a royalty fee, and then use the technology to line the inside of the LNG tanker to be able to transport fuel around the world. So even in an area like energy, you can still find very interesting and innovative business models that are doing something very unique. And they're not household names. But when we say we're looking for the future leaders of tomorrow, these are the sorts of businesses we're looking for. One company I will go into a little bit more detail is Transmedics. We have that in the fund as we do with GTT, which I just mentioned earlier. But Transmedics, it plays in the organ transportation space. So currently, as we speak, the gold standard for organ transport is effectively a glorified esky. It's basically a small container. It's got a bit of ice. It's a very cool environment. You put the organ in there, whether it's a heart or a liver or anything like that, and then you transport it. What that does, it gives you maybe 3-4 hours duration for the organ to be able to take it across geographical distances, line up the surgeon, line up the clinic, line up the recipient, and you've got a 3 to 4 hour window to do it all before the organ effectively becomes unusable. So it puts a lot of stress on the system. A lot of theatres just have to drop what they're doing, or elective surgery's got to get postponed when an organ becomes available because it has to take priority. What Transmedics have done, you can see a visual image of that. It looks like a small chest of drawers or a little credenza. You put the organ in there. The temperature is not cold. It's actually 37 degrees, which mimics the human internal temperature. If you put something like a heart, as you can see in that image there, it's hooked up to electrical wiring. The electrical wiring provide pulses to the heart. So you can actually see this on their website, but the heart actually beats as it would in a human environment. It's got the same temperature. They're running a synthetic blood-like fluid that goes through the heart, which mimics, again, the blood in terms of vitamins, nutrients, oxygen, all those sorts of things. What that means is for something like a heart, you can get up to 48 hours duration where the heart can stay in this environment in that device. 48 hours basically means if you have a heart become available in Seattle, for example, in the Pacific Northwest of the US, but for whatever reason, there's no recipient available, but there is someone in Florida, for example, which is all the way in the southeast corner of the US, you can put this device on a plane, fly it from Seattle to Miami, and then organize the recipient, the surgeon, the clinic, everything, and you've got plenty of time to spare. And so this particular device, Transmedics, they are taking share quite substantially from the existing legacy technology. It's a much more superior technology. A lot of clinics around the US and increasingly around the world are signing up to using it. The founder of the business is still involved. He did his PhD in this area and he's gone on to take it from a concept theoretical thing into practice. They did about 3,000 organ transplants last year. Their target is to do over 10,000 by 2028, so a tripling over the next 3 years, which we think is definitely achievable. And they're taking share. They're profitable. They got really good margins to the point now where they actually own 28 of their own jets, because they used to charter out a lot of private jets. And then they realized they were spending so much money chartering out private jets that they realized actually it's cheaper for us to actually own our own fleet and put all the volume of transplants onto our own planes. So they've got now 28 planes. They maintain it, and then 80% of the volume they do goes through their own plane network, and the remaining 20%, which they can flex up and down depending on things like seasonality, etc. They'll use a private chartering service for that. So it's a one-stop shop, and it gets you from basically from the site of the organ becoming available, whether it's a crash or a hospital death or whatever it is, all the way to where it's going to be received. And this is just sort of putting some figures on there. So the opportunity is huge. Right now, they have FDA approval to use in lungs, heart, liver. They're going to do trials for kidney very soon. Kidney is the largest segment in terms of volume in the US, and they haven't even touched that segment of the market yet. There are more kidney transplants than there are heart, lung, or liver. So that'll be something they'll do. They'll need additional approval for that, but they'll sort of go through that process. So in terms of growth drivers, not only can they increase just from taking more share in the existing categories, but over time they will get into kidneys. Over time they'll expand further and further outside the US, because right now about 90% of the business is in the US. They'll take this technology to places like Europe, potentially Australia over time as well. So there's geographical growth. There's growth from different organs. And then there's the existing growth by taking more share in the areas they're already playing in right now. So hopefully it gives you a flavor again for another very innovative business, not a household name, but doing something very interesting, very profitable. And it's in that small mid cap universe that we look for. Ferrari, I think no one really needs an introduction into Ferrari. Ferrari back in 2020 and 2021 was a small mid cap name. We actually had an investment in Ferrari for a little period of time before it became too big. So it was one of the successful graduates of our universe, so to speak. Another one is Cheniere Energy, which is an LNG exporter in the US. We had that for a number of years before the war in Ukraine pushed up energy prices and pushed up the value of Cheniere, and we had to divest of it. But this just sort of gives you an idea in terms of some of the graduates. We do sell stocks that become too big because we want to remain true to label in terms of maintaining a global small and mid cap portfolio. So we have a sunset clause, which basically means once it graduates out of our universe, we have up to 12 months to sell it. But what we don't want to do is hang on to these things for years and years and years, and then you fast forward 5 or 10 years and it becomes a mixture of larger mega caps and small and mid caps, because some have just continued to grow. Another thing that we think separates what we do versus a lot of others is we segment the universe into these 4 buckets: quality, value, transition, momentum. And we have exposure to all of these. So it's roughly about 40% in quality, 30% in value names, 20% in transition, 10% in momentum. That proportional breakdown has come from a 30-year back test that we did, looking at the factors that outperform. And so quality is the dominant style factor 4 years out of 10. Value, this is globally, value is the dominant style factor 3 years out of 10. Transition is really your special situations, your turnaround names, that they outperform 2 years out of 10. And momentum is typically your cyclical names that are just rallying from the bottom all the way through to the top. They outperform about one year out of 10. So, and what that means is by having an exposure to all these different styles, it means that we can do well in different market environments. So if I sort of go back to calendar year 21, if you remember, interest rates were close to zero. It was a very high growth period. It was all about technology, meme stocks, cryptocurrency, ARK, all those sorts of things. And it was a very growthy, momentum year. We outperformed in that calendar year environment. And then you roll forward just 12 months to calendar year 2022, and it was the exact opposite of it. Interest rates were going up, inflation was going up. It was a bear market, and everything that did well in 21 sold off quite violently in 22, and everything that was doing well in 22 had done poorly in 21. And we also outperformed in calendar year 22 as well. So that by having an exposure to these different styles, it means we can actually do well, irrespective of the prevailing macro regime, irrespective of what's happening to interest rates, irrespective of whether growth is on the way up or down, anything like that. It basically lets us outperform in an all-weather fashion, which is been supported by the almost 5-year track record of the fund. This is looking at the top 10 right now in the fund. Most of these names, I presume, would not be household names. You may recognize, a handful of those, but I'll highlight a few things from this. Firstly, you can see from the business description, they're very varied in what they do. We don't have we're not concentrated in one particular theme or one particular sector. You can see there in the founding year column, most of these businesses have been around for an incredibly long period of time. I think AppLovin is the one that's been around for the least, and that's been around for over a decade. But most of these businesses have been around for 30, 40, 50 years plus. The final thing I will also highlight is the far right column, which is what these stocks have done over the past decade. So this is backward looking, not forward looking. But you can see there, most of these businesses have done incredibly well. Games Workshop in the UK is actually up 45-fold over the past decade. This is basically to say that if we do our job correctly in identifying these future leaders and we invest in them early enough, we can actually enjoy extraordinary gains over the next 5-10 years. You don't have to just be invested in Microsoft and in Apple and in Google to be able to get really solid compounding returns over time. There's so many names in this universe that are doing incredibly well. Most of them are not household names. You just have to do the work to find them and identify them and invest in them early enough. This is just giving you a quick outline of the fund. I mean, I won't dwell too much on this. We usually hold about 50 names. Typically, we're looking to buy businesses somewhere between 1 and 40 billion US dollars. So it's about 60, 65 billion Aussie dollars. And you can see there's some guidelines in terms of industry and country limits. We've got some exclusions there. And then finally, that sunset clause that I mentioned a bit earlier in terms of once it graduates out of our universe, it's no longer a small or mid-cap name. We have up to 12 months to sell it, but at that 12-month anniversary, it has to be out of the fund. And then the Australian unit trust was domiciled or launched on the 28th of September 2020. So why global mid caps and why active management in this segment of the universe? There's a high dispersion of returns, and so it really remember what I said earlier. Nowhere near as many brokers or investors looking at this segment of the universe. So there's the winners do incredibly well, the losers do incredibly poorly, and there's that vast dispersion of returns. So active management does incredibly well in this environment in being able to pick some of these attractive winners over time. From a short-term perspective, small and mid-caps look certainly attractive on a valuation basis relative to larger mid-caps. On top of that, you also have the structural element to it as well, and you can get beautiful compounders over time. And it also is a way to diversify away from your Mag 7 and your mega cap US names as well, while still also getting very, very attractive returns over time. We've got an ETF version available of the fund, not only a unit trust, but an ETF. The ticker code is FCAP. And so basically it's a well time-tested philosophy and investment process that's generated returns across different market environments over time. There's the two PMs, James and myself, small and mid-cap specialists. We've been doing this over time. And then the asset class itself as well. It's a very attractive segment of the universe. And yeah, if you wanted to know a little bit more about the fund, a little bit more about what we do, you could just visit our website, fidelity.com.au, and you can go to our landing page there, and you can either pick the unit trust or the ETF and find out more information and updates and all the rest. But with that, I think I'll hand it back to you, Jeff.
Excellent. Excellent. Well, very nice, clean run through. Just talk a little bit more about the fund. You've been domiciled in Australia for coming up to 5 years now. Is
Yeah.
it available to retail investors, not just wholesale or anything? And yeah,
Absolutely, yeah. So if you go to the website there, you can invest directly through the website. I think the minimum investment for the unit trust is 25,000.
right.
Alternatively, if you just go to the ETF, you can just buy that through your brokerage platform of choice, and you can access that for even less than that.
Right. So very now with the ETF, very low cost access. Really just
Absolutely.
don't do it from home type stuff. The talk a little bit about the sort of difference in PEs between mid caps and large caps. Perhaps by just telling us how the PE of Transmedics. Do you know what that
Yeah.
is?
Yeah, so the PE of Transmedics right now is about 30 times,
Mm,
which optically seems quite high, but you've got to remember this is a business that's growing revenues to the tune of about 25-30% per annum. This compares to the Mag 7, broadly similar PEs, I would say off the top of my head, and they're probably growing revenues, probably by half that amount. They're probably
mm,
growing revenues high teens as opposed to somewhere in the region of 30%. So Transmedics is one of the more expensive ones in our fund. The average PE of our portfolio is about 21 times. Forward PE is about 21 times. The market itself, the small and mid cap market, is about 17 or 18 times, which is a lot cheaper than the broader universe.
mm. Well, Transmedics certainly a lower PE than some of our high-flying medical devices and medical related stocks in Australia. So, yeah.
Absolutely. I mean, even if you think about it, CBA is trading at a PE of roughly about 30 times as well. So you've got two businesses trading at same multiple. One is already incredibly well penetrated to the largest bank, the largest business in the country, and the other one is still in its infancy in terms of growth there, and they're trading at the same valuation multiple.
Mm. So the basic premise is, and by the way, I should remind people to generally anyone who's on the webinar to ask any questions they wish. A little unusually, we haven't got, you either done a really, really good job, but we haven't got any open Q&A from the audience at the moment. So I'd encourage people to ask some questions, but I'll continue. So the basic premise is, over the last 25 years, mid caps have outperformed large caps, but over the last 5 or so years, maybe a little bit longer, they've effectively underperformed, or the valuation gaps grown larger. And
Yep.
you're not trying to make you're too experienced in the sector to make wild claims, but you want to comment on that?
Comment on the reason for the underperformance or whether I
No,
think
I
it's
think
likely
just
to
the fact,
reverse?
yeah, the reversion to mean
Yeah,
that everyone is
yeah,
hanging out
yeah.
for in yeah. So yeah.
Yeah, yeah. So look, I mean, over time, this segment of the universe, from a growth perspective, is definitely going to give you more growth. I mean, it's just simply the law of large numbers. You have companies like Microsoft, Nvidia, they're the size of countries now, and the expectation is they will continue to grow 15-20% per annum. I mean, it's almost equivalent to saying, can the Chinese economy grow 15-20% per annum for the next decade? Or the UK economy, or the French economy, or the Australian economy. This is the size of some of these businesses, and quite simply, they're just going to run out of customers to be able to maintain that high growth potential. So, whereas the small and mid caps, certainly a long runway for growth there. So in terms of being able to provide you with more revenue and earnings growth over time, I still see that in the small and mid cap universe. What's really driven a lot of the returns in large caps, in addition to the earnings being abnormally high. There's also been the valuation multiple re-rating, but that's largely run its course. I mean, we've seen the large caps re-rate from being cheaper to small and mid caps to being substantially more expensive. I think that's largely run its course there. So I would expect both of those two things to reverse over time. Growth in small and mid caps to earnings and revenue growth to start to outperform large caps. And then some of that rebalancing of the valuation multiples back in favor of small and mid caps as opposed to large caps.
So are we seeing that in funds under management flows? That sort of reversion mean expectation being changed with money going in, or is it still going out? Huh?
Yeah, into small and mid caps, I
Mm.
would say certainly in the last 2 years, the level of interest has dramatically picked up. The type of conversations we were having 4 or 5 years ago, there was a lot more by way of us having to convince people of the merits of the asset class. I think a lot of that has shifted in the last year or two. We're seeing a lot more people coming to us and expressing a desire to sort of move away at the margin from some of those large cap names. And so I think we're having to do less convincing of the asset class now than what we used to have to do 4 or 5 years ago. And conversely, we're also seeing some of the flows pick up. It hasn't taken off completely, Jeff. I don't want to give you a misperception that money is pouring back into this segment of the universe in spades. It's not yet, but we're seeing I think the early signs of that.
Okay. And obviously going on this webinar will make a substantial difference. So
I hope so. I absolutely hope so.
Okay, so now we get to the difficult questions. Padam asks fee structure, question mark. Want to just talk about your fees? Yep.
Yeah. The fees is 1.1% flat fee, no performance fee.
Okay, so no performance fee above the MSCI mid cap.
No.
Okay, so just 1.1.
Yep.
Thank you.
Yep.
Ross asks what Australian stocks are in the fund.
Right now we have James Hardie and we have ResMed. They're the only two Australian names we have in there. You've got to remember, Australia is about 2 or 3% of the global universe, so it's relatively small. It's also relatively mature and quite expensive in terms of you can find similar businesses in terms of quality, etc., offshore at substantially cheaper valuation discounts. And it's no coincidence that both James Hardie and ResMed, which are the two Australian names, are predominantly exposed more to overseas growth, especially in the US as well. So they are listed in Australia, but actually the opportunity set they're playing in is much larger than just Australia alone.
How long have you been in those two, ResMed and James Hardie, roughly?
James Hardie's probably been about 2.5 years.
Okay.
ResMed, basically after the stock price sold off quite aggressively towards around August, September of last year, after GLPs became a big thing, and the ResMed price sold off on fear that GLPs and Ozempic, etc., might eat into the sleep apnea market. We saw that dislocation. Our analyst was quite positive on that, and we took advantage of the reduction in the share price.
And they would have both made a strong contribution over the last year for you. So
James Hardie less so, because obviously it was doing reasonably well up until they announced the merger with AZEC, and then the share price.
That's true. Yeah,
the share price got hit. It's recovered. It's recovered probably most of that since then, but up until that point, yes. But ResMed certainly has made a strong contribution over the past 12 months.
Okay, so previous years for James Hardie. Your timing looks quite good though, in that sense. Brian asked the question: is the fund leveraged in any way?
Absolutely not.
No leverage at all.
No leverage, no derivatives, no.
Okay, Raja has asked, why was there no distribution for FCAP ETF last year, or is it upcoming? Just in terms of...
So we actually launched FCAP on the 28th of May in 2024. So last year was, we had only been listed for a couple of months. We did make a distribution a few weeks ago, which was for the, I think it was time July 2025. So that was really after we had a year of listing.
Okay, so that should answer that. performance-wise, compared to the MSCI mid-caps, world mid-caps?
Yes.
Yep.
We have outperformed on a net of fee basis by about 150 basis points annualized per annum over 5 years.
Okay.
Net of fees.
That's a great performance.
Yes. So in absolute terms, that number is closer to 14%. I don't know the exact number because it obviously moves around. But that number since inception is somewhere between 13 and 14% in absolute terms. And relative to the benchmark, it's roughly about 130, 150 basis points above benchmark. Both of those are net of fees.
So Fidelity is enormous. I mean, you're hitting the $1 trillion US club.
Yep.
This style of investing, is it how much are we talking about globally? Are in mid caps? How much support do you get from your peers overseas? That style of stuff.
A huge amount. So we have somewhere in the region of about 120 analysts all around the world. That chart that we showed you there earlier, geographical, it was actually emitting as well. Canada, we have a large research team in Canada as well, but that's with a JV with our US sister company as well. So it's not a wholly owned part of Fidelity International. But we have over 120 analysts around the world. There's somewhere between 30 and 40 analysts who are deeply ingrained in our segment of the universe, who not small and mid-cap specialists, but quite a large number of what they cover is in the small and mid-cap universe. So just to take a step back, the way the analysts are assigned, it's by sector and geography. So you'll have someone doing, for example, US banks. You'll have someone doing European industrials. You'll have someone doing Asian shipbuilding, or Southeast Asian trading companies. So it's by sector and geography. So they cover up and down the cap spectrum. So someone doing US software, for example, would be covering Microsoft, but could also be covering like Cadence or Synopsys in our universe or something like that. So they're not sort of dedicated to large or sort of small and mids, but we'll engage with the analysts, and we meet with analysts on a rolling quarterly basis. So we, on average, catching up with about 3 analysts a week over Zoom, and that means either early morning meetings for us and afternoon or evening meetings for the Canadian analysts. Or it means afternoon and evening meetings for us and early morning meetings for our London and European-based analysts. And we're trying to leverage their highest conviction names, their best ideas into the portfolio. And roughly about 90% of the fund is buy-rated names from the analysts. So we are leveraging that resource network quite extensively all around the world.
Right. And that's why you're actually able to do it with a relatively small number of people.
That's right. So
Australia,
just James and myself in Sydney, the two of us making the final decision. But the input is dozens of people around the world. And our analysts, I should mention, like when we say they cover a company, it means they're meeting with the company at least on a quarterly basis. They're meeting with the C-suite management team. They're meeting with IR. They're engaging with sell-side brokers. They build a model forecasting out the P&L, balance sheet, and cash flow statements out a number of years, doing valuation work on the company, doing industry channel checks, talking to competitors, talking to suppliers, talking to customers, getting independent experts to sort of weigh in as well, doing select calls with independent experts. So it really is a holistic 360-degree view of that company. And they're doing that for about 30 companies each. On average, the analyst covers about 30 names specialized in sector and geography. So they become subject matter experts in what they're looking at, and they're utilizing a range of inputs and then sort of feeding that back to us.
Yeah, it sounds like a wonderful filtering model. All right, we're come up nicely on time. If anyone's got any other questions, you've got about 4 seconds to type it in. And Maren, why don't you just make any final comments that you wish to make? And thank you very much for presenting to the ASA members today. And we do like hearing from large fund managers like yourselves who our members have been I'll use that phrase for many years. So appreciate you coming on. Any final comments?
Look, I mean, I just reiterate, I would really encourage people to look at this segment of the universe. It's a lot larger and a lot more mature and a lot more profitable than what you may think. Whether you choose to go with Fidelity, anyone else, I really think now is a really good time to be sharpening your pencil, doing some homework, looking at this segment of the universe, because the mega cap trade has been going on for a number of years. I feel like it's getting towards the end there. So it's worthwhile doing the work now, prepping in advance for if and when you want to rotate. But I think it's an attractive segment to be looking at.
And an attractive way to diversify.
Yeah.
So well done. Thank you very much, Varun, and thank you very much for your time and your good work. Okay.
Thanks, Jeff, and thanks everyone for dialing in.
Thanks to the audience for attending. So thank you very much, everyone. Bye for
Thank
now.
you. Okay.
Bye-bye.
Bye-bye.